There we are. So I'm the guy that's on the left, Vern Bell, President of Texas Elite Advisory. The guy on the right is Daniel Dower. He often participates with me on webinars, but he's not here today. So you'll just have to put up with me. We also have Kendra Morgan, who's just started with the firm about a week ago, and she's going to be supporting our advisor services outreach. In this webinar, I'm going to present Texas Elite Advisory's Elite Relative Value Strategy. By the way, if you have any questions that you need answered shortly, please go ahead and just text in your text box, or if you need us to send you something of that sort, please do text in that text box. Kendra will keep an eye on that. I generally forget to do that, but that's what she's going to be doing mainly today, is watching that text box to see if there's anything we need to do. So I'm going to describe our elite relative value strategy, and I'm also going to describe through the process of doing that how I've differentiated my personal retail investor practice from the huge crowd of competitors that we meet in the market every day. I'm also going to walk through how you can tap Texas Elite Advisory and other managers using the Interactive Brokers platform. Entire presentation should last about 30 minutes. The end part about Interactive Brokers I haven't done before, so it may take a bit longer for that, but we'll see. So if you need to hop off for some reason, the webinar will be recorded and you can view it later. Okay, so the overview here. Our equity investment strategy provides competitive returns with low volatility by using price timing within a carefully selected basket of U.S. large cap equities chosen to provide exposure to global markets. We invest based on fundamental analysis with an emphasis on financial stability, long-term earnings, and dividend history. In other words, we are really classic value investors. So in the next few slides, I'm going to give you a high-level overview of value investing principles. This may be remedial for some of you, may just be a repeat, but I won't take that long, and I think it may be helpful. Then we're going to drill down on performance and talk about how you can use the strategy to differentiate yourself kind of during the whole flow. We'll do that. So let's take a look at our situation with competitors. There's somewhere between 300,000 and 500,000 people who call themselves financial advisors in our country, that is in the U.S., and that kind of depends on your definition of a financial advisor. Could be sometimes an insurance agent will be presented as a financial advisor. So here's a huge question. How do I differentiate myself in the midst of that huge sea of competitors? I have my own book of retail clients, and virtually all of them came through my LinkedIn contacts. I started contacting people with no credibility and had to build on nothing more than what I could find in their profile. So I found that positioning myself as an expert in something that was different, something that no one else was bringing to them, gave me the best chance of breaking through. And for me, that something is value investing. The elite value strategy, or elite relative value strategy, has a great track record, but the real differentiator is how well you can articulate the many value investing stories. And there's a ton of them if you want to get down into studying them, and I'm going to show you how to do that very briefly. There isn't a magic formula. You just learn the history of value investing, learn the stories about Benjamin Graham, Buffett, and so forth, and the other great value investors, and learn to tell them. And people find it interesting, especially when it relates to real human beings. So you're often trying to displace entrenched competitors. Somebody's already in the seat of being the quote-unquote advisor. And since roughly 2011, there hasn't been a significant correction, so there's been very little pain. Everybody looks like a hero. As long as you're a well-diversified portfolio, and performance is going to be pretty much in line with expectations. So at least 95 and probably more like 99% of people who are in this business default to their employer's modern portfolio theory-based asset allocation model. And virtually all of these portfolios correlate with the market. This is what the industry touts as the well-diversified portfolio. Among duly registered advisors, advice is so homogeneous that they're reduced to a single value proposition. Hold the client's hand and help them stay in the market when there's a correction. This 30-second Wells Fargo ad, and I think it really makes this point well. So take a look at it if you would. I mean, if that's the whole value of a financial advisor, to me, that's just kind of a loser. There's got to be a lot more to it than that. It's no wonder if that's the view of ourselves as a profession, the robo-advisors are taking over. When I'm engaging new client prospects, I have things that I bring to them that nobody else does, and I think that's absolutely critical. For most of us, value investing represents a totally different way of thinking about investments. It's a paradigm shift. It's a big change. And Benjamin Graham is widely recognized as the father of value investing. He wrote two super important books, Security Analysis, that was published in 1937, and The Intelligent Investor, published in 1949. Together, these two books are the foundation of value investing. Many value investing practitioners consider The Intelligent Investor like the Bible of value investing. And Graham was Warren Buffett's mentor, college instructor, and business partner. Buffett studied under Graham at Columbia University and later went to work for him. Buffett was his only A+ student. I like to use this article. It's old. It's 1985. I mean, some proponents of the modern portfolio theory were claiming that Buffett is a statistical anomaly, and you still hear that out there. They claim that his amazing performance resulted from sheer luck. He rebutted those claims in the article, Super Investors of Graham and Doddsville. It's not all that big. I think it's 8 or 9 pages, but it describes the founding principles of value investing, and it cites numerous other money managers who also successfully applied value investing. Super Investors is available online from the Columbia Business School. Just Google Super Investors of Graham and Doddsville PDF, and this link you see in here should pop right up. I will pointer on there, and you know, it's a good way to introduce people and start a conversation about something that's not just, hey, I'm going to hold your hand because the market's crashing on you or whatever. So this is basically the core of our strategy. We use value investing principles, and those principles are know the intrinsic value of your stock, and that's a calculated value that we work out. And I think every practitioner has their own unique calculations. Of course, there's classic Graham models that you can go to that are helpful, but you know, we have our own unique model. Think like a business owner. So this is part of that paradigm shift. Start thinking of the businesses actually, rather than just a bunch of stocks or a basket. And that's the term you hear bandied around, is I'm going to buy a basket of something. We look at each business as something that stands on its own. Take advantage of Mr. Market, what Graham called the market vicissitudes. I kind of like that particular word. So you know, you want to buy when a stock is cheap, and you want to sell when it's expensive, and that's really the basic simple thing. Maintain a margin of safety. This is really important. You have to have. You might be right about your intrinsic value, but you want to factor in some numbers there that give you some safety. Invest within your circle of competence. This principle basically is the reason why, in our case, we don't do a lot of really fancy high-tech stuff. It's simply not within our circle of competence, so we stay away from it for the most part. I think we've been into Microsoft a few times, but that's not all that difficult to understand what they're doing. Invest on fundamentals, not on trends or speculation. So we're not trend traders, and we're not saying that trend trading is a bad thing or won't work. We're just saying that's not what we do. This is the competitive philosophy over here, modern portfolio theory. And this slide kind of contrasts the differences in the way they work, in the way we work within those disciplines. You know, on our side of the world, basically we're really interested in real business knowledge, is how do business works. We're buying companies, we're buying businesses that need to be profitable. We buy stocks. We can take options on stocks. Options are great things. Over on this side of the world, basically most of these people have computer models, and they use mutual funds and ETFs. And this is why Robo is an easy way to go. We use fundamental analysis. We're interested in all the data. And over on the MPT side, it's correlation and volatility. We're interested in growing clients' assets. That's basically it. Interest over here basically is hold on to your clients. You kind of got that from that little commercial. Hold their hands while things go down. And we want to please our existing clients and grow money. And for the most part, that's how we grow our AUM. The purpose over here really is to try to constantly add new clients. Difficult for me to understand how they do with the offering that they have. So how do we differ from other value money managers? There are other money managers, other value money managers. Some of them do quite well and have great strategies, but we're not the same. Every value manager has their own little approach. Remember, at a very high level, value investing is not a strategy, it's a paradigm. It's a way of thinking and a bunch of general rules that you can follow that help you get there. You need to get down to the details to identify the specifics of a strategy, and it's important who's managing that strategy as well. For us, we manage large cap multinationals only. That's the only stocks that we buy, and we only buy dividend paying stocks within a very small universe of stocks. And that's because large cap dividend paying US firms, there's not all that many of those. So our portfolio as a result is highly concentrated. And what do we mean by highly concentrated? Well, in the industry, you know, the idea is well diversified, and that means lots and lots and lots of stocks, which frankly just means they're going to be totally correlated with the general market, or perhaps they can have some sector correlation, but they're not going to do anything special. So what do I mean by concentrated? I mean pretty darn concentrated. And, you know, we rely on Buffett and the others who have, you know, vast amounts of experience in this area. This is from a little video you can find on YouTube. It's Warren Buffett diversification. In fact, you'll probably find half a dozen places and different speeches he's made where he's made this same claim. And just to quote what he says, the question's about diversification, and I got a dual answer. If you really know business, you probably shouldn't own more than 6 of them. If you're not a professional investor, buy an index or a robo. But if you bring the intensity of a professional, then you really shouldn't have more than 6. That's an interesting view, and I think it contrasts very, very much with everything you hear in the industry. So just checking my watch here. We're down about 15 minutes. We're doing okay. I'm going to move along as quickly as I can, though, because there's quite a bit to cover. We have, of course, a proprietary value model. I mentioned that. And our returns we generate from these areas. At least this is the way we figure our business should work. You know, we're going to have real growth in the businesses. Price inflation should come along, possibly more than that, possibly. Dividends, stock buybacks, long-term expectations, buy and hold, and then active management. You sum it up, our goal is to hit about 15% over the long term. So we're going to touch on performance here for a little bit. And first thing I want to say is you got to make sure you're comparing apples and apples, or oranges and oranges. You're not comparing different things. And I see an awful lot of hypothetical back testing out there on data sheets these days. That's not what we do. We do not use hypothetical back testing. And personally, having done some of this, I don't care for it, and I think it's disingenuous, frankly, and not everyone agrees with me on that, but I just don't see how it ends up working using hypothetical back testing. It doesn't tell you anything about how the manager is going to perform and do his job, and I think that's critical. So we contracted a company actually out of Austin, Theta Research, and they tap one of our accounts and monitor that account every month and report every month. This is a chart from them. They produced this chart. and which is a little difficult to get to. So I'm going to walk through so you can find out. Bear in mind, this is a 2% fee is added to everything on there, so it's a little different when you're dealing with a institutional client. But if you're going to have something out in the public, it has to include the fees, and our ADV says 2%. So to view the table of monthly returns, you really need to go to our website, texaseliteadvisory.com, hover on performance, or you'll hover on strategy, and this thing will drop down, and then click on performance. When you do that, you'll go to Theta Research instantly. By default, once you put your email address in, and it'll take you over to this page. It doesn't tell you very much about our results, other than the fact, I think on here they mentioned the 2% fee right about there. But that's about it. You need to click on the little chart. It does say that up there, but it's easy to run through it and say, gee, is that it? I'm out of here. Don't do that. Just go ahead and click on the little chart. You'll see another thing, another little chart, which really isn't all that helpful either. But what you really want is over here where the arrow's at. Click on the monthly statistics button, and that'll break you down to a real detailed. It'll give you that chart that I just showed you a little bit ago, and every month over our 10 years, every month of data will be in there. You can examine that all you want. It has 2% annual deducted from it, of course. So Theta Research used our GIPS compliant data to construct everything up to a certain point. Not everything near term has been examined, of course. We're in the process of getting everything examined from June to the end of the year. Last year now, we're really deeply into that. And then we'll pick up and go on with 2018. But we'll probably only have the examination done once a year. It's just too time consuming. So this is where we're at. We use Ashland Partners. We're talking 10 years, April 30th, 2008 through April 30th of 2018, which is pretty cool. We're there. During that time, we've never had a losing year, which is, I think, very cool. I mentioned that, so let's go on. Institutional spreadsheet. I'm going to bring up a Excel file here, assuming I can see it. There we go, right there. Boom. Should be able to see an Excel file. This never goes out to retail clients. It's strictly for institutions, and we had this constructed to make it easier for people to calculate what the performance would be with their individual fee. So if you go down to the bottom here, you'll see a chart, and it shows our performance and it shows the S&P 500. So our performance is there and the S&P 500 is there, which is, I think, a good thing. You can go up here then and you can see all the monthly numbers laid out. We use SPY as a proxy for the S&P 500. You go in and key in, like we have a 2%, and go down and see how much that has an effect. Important things here. And with the 2%, our cumulative since inception is 227.18, and the SPY is 133.35. And our since inception compound, we haven't quite hit our 15%. We want to do more. We need a few good years for that, though. And frankly, these years here have been really rough. All of these years where there's not volatility makes it very hard for value investors. The market just keeps climbing up and up and up. So there you can see the net of fees number, and you can see the gross of fees number. Anyway, this is available for you if you want it. Please just send an email to ask@texaseliteadvisory.com, and we'll get that out for you. I mentioned I've used our strategy to bring in new AUM in the face of competition. We do have a book that talks about value investing and the principles that we follow. It's available via PDF right now, but we're in the process of getting that transcribed and put onto Amazon, viewable on Kindle. So that's going to be available down the road. Let us know if you have an interest in that. We also, I think these particular assets are very helpful. I typically go out and buy some of these value investing little books. You can get them, $5-6 a pop. This is really a great little DVD that it gives people, I mean, even a retail investor can have a pretty good idea how everything works. Lots of stories in here. So it'll captivate and hold interest. Of course, the intelligent investor, but most clients won't read it. It's too intense. The Einstein of Money is a recent book, which I just read, I think, a year ago or so. Great book. Lots of great stories in there. A lot of detail about Benjamin Graham. I found some really worthwhile meat there to use. Okay, so still got a few minutes. I'm going to walk through the Interactive Brokers Wealth and Money Managers piece of this thing. Different ways to tap our strategy. In order to get in and connect up with another money manager, say you're just a wealth manager, you're not a money manager. There's two classifications. There's wealth managers and there's money managers on the Interactive Brokers Marketplace platform. So in order to get into it and do something with it, you need to open up Investors Marketplace while you're logged in. Go through search services, investing, money managers. Then you can get in to see who's out there in the way of money managers. I cut and pasted us in there. I guess that's a bit self-serving, isn't it? But we're in there under money managers, and you could click on more info. We would have to communicate and work out a separate agreement as to exactly how we're going to do things. But that's how you hook up with us or any of these other money managers that are out there. That's the page from which you would contact us. So another way, there's two ways to go about getting in contact us. Another way is to work with Interactive Brokers Asset Managers management. Interactive Brokers purchased Covestor some time ago. They have a relationship there, and you can simply hook up with them. It's pretty easy to do, and that will give you access to all of the different stuff that Covestor has, Interactive Brokers has. There's a lot of money managers on there showing 23 results right here. We're on there. You can see us. There's a little arrow. Once you're hooked up with Interactive Brokers, the asset management piece of Interactive Brokers, you can go through and pick out what you want. They also have a ton of asset allocation pieces, and those are very, very inexpensive. So it's 8-9 basis points to put your client's money in that if you're so disposed. Probably not something I'm going to do immediately, but there you are. So we are on time. We're doing good. Contacts and help. We just added Kendra. I mentioned that, I think, early on. There's her phone number up here. You're welcome to write that down if you like. She's strictly dedicated to advisor services. And Interactive Brokers Asset Management, you can email their client services people, or if you want to give me a call, contact me. I'll be glad to hook you up with Joe Sullivan. He's the guy that I've worked with over there. There's our disclaimer. If you have any questions or anything, now would be a good time. Otherwise, I'm going to pop off of this, and we can all go about doing other things with our Friday.